Good morning. Welcome to the April 19th, 2022 Budget and Finance Committee of the Recreation Centers of Sun City West. We have all of our committee members here, including Anita DeGumbia, who is with us from, is it Wisconsin?
Yes, and it's cold and snowy.
I'm having a hard time hearing her. Oh, wonderful. Well, it's just balmy and beautiful here, which is exactly what you wanted to know, isn't it? First order of business is to approve the minutes from our March 22nd meeting. Richard took those minutes, and I appreciate that. Do we have any changes, additions, corrections? If not, I will ask for consensus to accept them as written. Okay. And our acting secretary today is Dick Rhodes. We appreciate that. First order of business, we are going to hear our quarterly CapTrust presentation from Frank Piles and Nathan Erickson, who are here with us today. So I'll turn it over to you two gentlemen.
Thanks everyone for being here today. Normally, I, Frank Piles, will start off with a little bit of a portfolio review, but as you'll see, and probably no likely surprise, know that the market has been anything but boring recently. A lot of ups and downs, a lot of volatility. So I actually want to start off today with Nathan Erickson providing a little bit more context on what's going on in the landscape of the investment universe. It's up to you. Go ahead.
What's that? So just to set the stage a little bit on market returns, this gives you a sense of across broad asset classes. Just looking at the shaded bars, the full color bars are last year, 2021, but the shaded bars, you can see there's really nowhere to hide in the first quarter. All equity markets were down, and more relevant to the Sun City portfolio, the bond market was down right about 6%. So it's been a challenging period of time. You know, the biggest driver of the bond market return, I think there's a pointer on here. Oh, I shouldn't have done that, sorry. There's a pointer, there we go. Has been the change in the 10-year treasury yield. So you can see at the end of 12/31, it was 152. The end of March 31st, 232. So when the 10-year treasury yield rises at a quick rate, that drives the value of bonds down materially. And that's why you see in the first quarter, the return in 10-year treasury down about 7%. Now, Frank will show you later, our fixed income exposure has done better than the market, but the market has been the key driver of performance so far this year. There's a couple reasons why the yield has gone up that much. One is, you know, the Fed is signaling that they plan to raise interest rates, and they've already started, and they're going to continue to raise rates throughout the year. That has a bigger impact on the shorter end of the curve, this 1-year number, than it does on the 10-year. The other big driver has been inflation. And the fact that we've had inflation and it's been here longer than expected, and the expectation is that it will continue. We had inflation starting with COVID, challenges with the supply chain, and you know, we have some labor problems as well, which we've talked about before in this meeting, but it's been exacerbated by the war in the Ukraine. So that's affected oil prices pretty materially, as well as things like fertilizer and wheat as well. And so, the 10-year is adjusting to the fact that the expectation is there's going to be some inflation pressures for a period of time. I think it's relevant when you think about the Sun City portfolio to consider that while the fixed income portion is down materially, we still have 9 months of yield that will help offset that. So we're going to still earn some coupon return from our fixed income that will offset the loss that we've had so far. I also think it's important to put it into context. So while I think we're down about somewhere in the 6 to 7% range, that's the second worst drawdown for fixed income in 40 years. So we are in a very unique period of time. And compare that to if you had a lot of equity exposure, the worst drawdowns in equity are down 30, 40, 50%. So while nobody wants to lose money, and certainly not in bonds, the potential losses are far lower than they would be if you had a lot of equity exposure. So I think there's reason to be optimistic. One, if the war in Ukraine subsides, I think markets recover pretty materially. Two, I think inflation, while it'll probably stay high for a while, it should start to moderate a little bit. So we're seeing numbers at 7, 8%. If we start to see numbers at 6 or 5, the market will respond to that. And as I pointed out before, I think you've got some coupon income to help offset some of the losses so far. So it's been a tough quarter, but I think we like to tell clients, while we report quarterly, we don't invest on a quarterly basis. So it's important to know where you are, but this is a long-term portfolio, and we don't think there's any reason to panic or make any rash decisions at this point. We talk about headwinds and tailwinds just as we look ahead at the economic picture. Again, I think a material headwind is the war in Ukraine and what the outcome of that looks like. I've been telling clients, I think it's the first time in history, and I'm not a history teacher. Someone can correct me on this, but I think it might be the first time in history that you've seen a coordinated effort between political entities, governments implying sanctions, and corporations cooperating to put pressure on Ukraine. So it's no small thing for McDonald's to say we're going to walk away from 5% of revenue in Russia and just shut our stores down because we don't agree with this war in Ukraine. Or many other countries, many other companies who have operated in the same way. So I think that eventually has puts a lot of pressure on Russia to do something different. I mentioned more challenges with inflation and commodity prices going up. We talked about this last time. Wages are a big problem. Housing, energy prices, all continuing to rise. There's kind of a quip that's said about a lot of things, but the best cure for high oil prices is high oil prices. If they're too high, people stop paying, people stop traveling as much, stop using gas, demand slows. Same kind of thing can happen with inflation as well. And then the other material headwind, again, monetary policy. So, the expectation that the Fed's going to continue to raise rates, that's kind of baked into the market right now. But if that changes, if they say, well, instead of raising it a quarter point, we're going to raise it a half point, that could be a material headwind as well. From a tailwind standpoint, consumers are still very strong, lots of cash available to spend. Corporate profits are still very high, expecting corporate earnings to grow by 9%. That doesn't mean the market will grow by 9% because you can have some valuation adjustments, but companies should still make money in 2022. I think there's no better evidence than the mask mandate being lifted for travel that COVID is pretty much behind us now. Just cover this one last slide here on inflation. When you have the inflation environment that we're in, people want to compare it to history, and I think you hear a lot of people talk about the 1970s stagflation environment. We think it's more akin to kind of post-World War II because you have some of the similar factors of supply chain issues, increased demand from consumers. 1970s was characterized by some price controls and some other factors that really led to that. And so, if you just look at the shape of this diagram, and there's two things being shown here. You have both inflation in the blue. You have unemployment. Colors are missed. Green, yeah, they don't match up here. And then the combination of those two is what's called the misery index. But importantly, you see a big spike in inflation, and then things start to trend down, and that's probably what you're going to see. We may see plus 5% inflation for a couple of years, but we're probably at or close to the peak in terms of the actual number itself, and then we'll probably see some stabilization. Again, I think if you see that, the market will respond favorably to that. We've had questions in the past, and there is some concern around this idea of what's called a yield curve inversion. It's a really wonky statement, but it basically means when you have the 2-year treasury with a higher yield than the 10-year treasury. So when you think about interest rates, you should get paid for investing for a longer period of time. So if I'm investing for a year, maybe I get paid 1%. If I'm investing for 10 years, I should get more because I'm locking my money up for a longer period of time. So the idea of yield curve inversion is that instead of there being this kind of normal slope, there's a flatness and actually an inversion. I'm getting paid more for short term than I am long term, getting punished for being long term. And historically, that has predicated a recession. Now, we think this time's a little bit different because historically you saw yield curve inversions at the end of a Fed rate hike cycle, and here we're seeing it more at the beginning. So GDP still remains strong. We talked about corporate profits and consumer balance sheets still remaining strong. I do think this is more a function of the market hearing from the Fed, oh, you're going to raise every meeting this year. We're going to be at 2% by the end of the year. We're just going to price that in right now. And the short end just going from a quarter point to almost 2% immediately, as opposed to historically what would drive a yield curve inversion. So it's an important data point. It's kind of flipped back and forth between the 2-year being higher than the 10-year, but we don't think it's necessarily in this case going to mean certainty around a recession. So I'll stop there. Any questions on any of this or anything else that you might have questions about?
I just have a quick question. Thank you for a great presentation. In doing the readings, it's showing that around, May 4th, the Russians may default on their debts. Mm-hmm. Is there anything in there we need to be aware of? Is there going to be some type of factor long term, or is this just going to be a short term blip?
Yeah, well, I think the market has already reacted to that potential. There's a lot of Russian securities, Russian fixed income that's not even trading today. You can't trade in a number of issues, because the uncertainty around what could happen there is a challenge. In the big picture, Russia's a small percent of global GDP, a big percentage of like oil production and some other commodities, but on a GDP scale, not that large. And if you talk about equity analysts that are buying stocks in the region, they would tell you they think it's a blip, that at some point you're going to see potentially a change of control in Russia, and there's still some great companies there that are doing well. So I don't think you see a complete implosion of Russia. It's really just another step in on the path to some sort of change happening.
Thank you.
Any other questions?
It's an interesting inflection point, though, to think about. So what does Vladimir Putin do if his debt collapses? Does that push him to some fervency to move forward with the war or completely retreat? We don't know. It's a tough one. So I included this asset class quilt. There is way more information than folks even in the front row can probably read on here. But what I like about this is it's the returns by asset class over time. And I think the important part to point out, and I'll just pick a couple of colors just to illustrate the point, this kind of sky blue is fixed income, which is probably most relevant to this group. Going back into the post-financial crisis, 4 out of 5 years between 2010 and 14, fixed income was the place to be with double-digit returns. I'm sorry, that's real estate. Fixed income is sky blue. They're in the middle parts. So you're looking at the. This is going to be tough to point out because I picked the wrong color. Is it? The red button. Perfect. So there's this blue, and then there's this blue. Oh, perfect. Great. Thank you. So the fixed income portion is what I was trying to point out is, for a while, fixed income's kind of hovering around the middle. And then over the last little bit, 1.54%, the only losing asset class below cash in 2021. Tough to say where we're going to be going forward, but you can see cash is near the top for Q1 2022 at nearly flat, and strategic opportunities, more of a risky equity investment, is the real, air quotes, big winner in Q1 2022 with everything else losing ground. So I just point that out because it's very interesting to see that a diversified portfolio is important, because there isn't an asset class that is consistently on the top or consistently on the bottom. Cash for years hasn't paid much, which is why it's hovered near the bottom. But at the same point, cash is king in the last quarter. So transitioning a little bit away from the markets and the economy, I thought this was a bit of an interesting tidbit for the board to consider here. So every year we do at CapTrust a survey of all of our endowment foundation nonprofit clients. And this was just one of the items that I thought was an interesting fiduciary discussion for you to kind of take away and think about. This has a look at benchmarking of governance boards and structures. And for your group, in the 25 to 50 million space, the number of board members, about a third are 10 or less, about a third are 11 to 20, and about a third are 21 plus. There isn't anything to take away from this with respect to, like, you need to do something different at all. It was just more of a nice tidbit that I thought kind of validated that there is no majority here that is the right answer. It seems like the committee, the way you're structured, makes a lot of sense. And then the investment committee members in the 25 to 50 million space, more than half have 5 or fewer, and a full 90%, 89% have between 6 and 10, which is where I think your committee sits today. So let's take a look at the portfolio. The portfolio is actually on this slide is best read right to left. So 2021 is the far right bar at the top, a combined contributions of a little over $31 million through 22 year to date. We're down about $1.6 million. Current quarter is the identical number because that represents all of 2022. Looking at the performance a little bit, or the underlying portfolio a little bit, we're sitting in the same positions that we've continued to stay at, 90-10 allocation. Right now it's about 89 and a half, 89 and a third, to a little over 10. But that just has a little bit more to do with market performance than an intentional change to allocation. You can see down in the bottom middle, if I can highlight this here, there's the target allocation. We want to be about 0.5% in cash, 89.6 in fixed income, and a combined 9.9% in equities. We're basis points off of that, slightly higher in cash, slightly lower in fixed income, slightly lower in international equities. Looking at performance, so this is a breakdown over this page, and this is the entire portfolio. So we get into each section a little bit more in the next couple slides. So looking at the entire performance of the portfolio, the underlying holdings in the portfolio, we have not made any changes to the underlying securities. Again, as Nathan alluded to, we don't invest by quarter. So even though we're experiencing some slight diminished returns, that doesn't have a knee-jerk reaction for us to want to make any significant changes to the underlying portfolio. As we dig a little bit deeper, again, total portfolio performance. So the far right-hand side, this is since we took over. The benchmark of this portfolio, the way it's allocated, is down about 6.18%. The portfolio itself is down just over 6%, 6.02%. Looking at the left-hand side, this is the last quarter in 2022 year-to-date. This is a chart that builds upon itself, but because Q1 and 22 are the same numbers, they're identical. The portfolio benchmark that we allocate according to is down just about 5.8%. The portfolio is down about 5.3%, so about 0.5% of improved performance relative to what we would expect for the benchmark. So not exciting news. Nobody likes to take over responsibility of advising on a portfolio in a market that immediately turns negative. But I'll stop here just to ask if there's any questions that anyone has about the portfolio and the performance.
I just
Go
have
ahead,
a
Kathy.
question. I don't. This might be for Pete. Is this the first quarter where we've totally rebalanced our funds? So we're still not. We're still in the process of moving money.
No,
That wasn't a
actually,
very good question.
no, that's fine.
But
What hopefully everybody's aware of this, but if you're not, for years, it was in a 60% bonds, 40% equities, and that's not entirely accurate because we held about 3 million or so in CDs. It was actually November of 2020 that that was rebalanced to the 90-10 situation that we're at. This CapTrust investment advisor conversion is what he's referencing. That occurred in November or September of 21. So yeah.
I have a question. Do we, as I understand it, we're now at somewhere around 89 and a fraction.
That's right.
Okay. What's an acceptable range before we should run up the red flag here? Have concern.
Yeah, so we will rebalance the portfolio typically quarterly, or if there's a meaningful movement of a percentage points away from target. But at this point, the market fluctuates every day, so the basis points difference of 89.6 or 89.8 or even 90 could happen over the course of a week. That's not enough for us to typically, make a rebalance. But if it moved several percentage points, if we got down to 85.15, we would rebalance it back to 90.10.
I guess it just seems to me that we're already in a very conservative state, that if what we're saying to rebalance, we want to be more conservative. Is that a fair statement?
We would always rebalance to target. So the guideline from the portfolio, from the committee now is 90-10. So we won't stray far away from that more than the portfolio drift that happens naturally by 1 or 2 percentage points. But then on a quarterly basis, we'll rebalance it just to get back to even. And the idea behind that is, let's say equities take off and your portfolio shifts a little bit, it's down to 85.15. We're going to sell that 5%, take advantage of the gains, and move that back over to the fixed income side to maintain that 90-10 balance that we're instructed to invest by. And the same would be true the other way. If fixed income, there was a rush to fixed income, the equity portfolio or equities in general went way down to now we're at a point of it's 95.5. We would sell 5% off of the fixed income side to take advantage of the depressed prices in equities to rebalance back to 90-10.
I think the concern I have is, well, first of all, I understand that we're really talking about market influences.
Right.
I mean, there's no question about that. I'm not terribly nervous, other than from the entire global perspective of all of the factors. And I'm not sure what, if anything, we can do to rebalance, to compensate for that, because that's really kind of out of our hands.
Right.
So I think the thing that I would want to do, and I'm sure Pete spends sleepless hours worrying about this, is that
we do talk a lot.
yeah, how do we just need to continue to monitor this instead of standing around and wringing our hands, because I think there's very little, if anything, that we can do right now. I think we've got a good policy. I think that we're monitoring it well. I would just say that I really want to keep monitoring this and understand. Thank you.
Yeah, it's that's our job. We monitor every day. I can't stress enough how unique this environment is. I mentioned before, this is on track to become the worst fixed income market in history. It is already the longest drawdown, not quite the deepest yet, but we're not far from the deepest, that we've seen. But again, that's 10% down in fixed income. It's not like 2008 when equities were down 50%. Normally, when fixed income is down, it's what we call uncorrelated with stocks, or bonds are uncorrelated. Stock markets will be doing better. We'll show you in a page or two. They're both down the same amount. That's also very unusual. If global tensions rise, if Russia-Ukraine turns into a bigger deal, people will flock to fixed income, and your fixed income will rally. Now, equities may be down more, and you may still have a loss in the portfolio, but we don't think the right thing to do in this moment We wouldn't tell you in 2008 you should sell all your stocks. We're not telling you in the second deepest drawdown of fixed income that we should get out of fixed income and go to cash, because it does play a role, and we do think it's, there's a lot going on here, and we don't want to, as Frank said, make a knee-jerk reaction.
There's a lot of data on this page, and a lot of it is more benchmark specific. So what we're looking at here is just we'll start with the top section, the cash that you have in the portfolio. You have the FTSE Treasury bill, the Barclays 1 to 3 month T-bill. Last quarter was up all of 0.03%. Feels a little bit like your savings account at the bank. There's not a lot to get excited about there. But that's just the way that the cash position has been. It's more of a parking lot for taking advantage of moves when there's a significant change in the market. There hasn't been anything that's particularly appealing that's motivated our portfolio manager to actually invest that small portion of cash, which was 0.5% of your entire portfolio. But as you work your way down the page into the next section of fixed income returns, that last quarter and year-to-date figures are the same number again, because last quarter and year-to-date are the same. But literally every single position, negative, 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 some down as much as 8.5%, some down as much as 3.5%. The underlying bars in white are just how that fund performed compared to its benchmark. And again, across the board, literally in every space, there isn't any place to hide. We're at negative returns in the benchmark. Fortunately, in many circumstances, our performance is better than the benchmark. We've lost less than the market. That at the same time isn't always a feel-good story. As we switch from fixed income over to the equity side, it's the same story. Typically, you would expect, wow, the fixed income market's down, so the stock market would be up. In this circumstance, going back to 2 BNF meetings ago, I think I'd set the expectation that we're in a very real possibility that interest rates are going to rise and the equity market may be oversold and we may see a little bit of a retreat. We didn't know war in Ukraine was going to be the kind of impetus of that. But at the same time, I think we're seeing what we were peeking around the corner to look at, that the market is literally across the board negative. There isn't a place to hide in any of these spaces. And then even looking in the international space, it's nothing to get excited about there. The Fidelity Emerging Markets Fund down 7.61% Hertz relative to the entire emerging markets universe is negative 10.5%. Or the International Index Fund down 6.7 relative to the Foreign Large Blend Universe down 7.04. So the entire portfolio benchmark, kind of the bottom returns down there on the very bottom. Year to date through Q1, we're down 5.3% for the entire portfolio. The entire benchmark of what we kind of invest towards is down almost 5.8%. So it's about a 50 basis point or 0.5% better return than the market. And then all the way to the right-hand column, we decided to add an inception date. So this is the very first day that we started working with you, September 10th of 2021. The portfolio is down about 6% flat, we'll call it, relative to a benchmark that's down 6.18%. Again, nothing to get excited about or cheer about, but on the other side, our objective is to provide returns that are better than the market. We've done that, but in a negative yield environment or negative return environment. So I'll stop there. It's kind of the key takeaway I would say for today is nobody likes negative returns, but on the other side of it, we feel good about the portfolio and where it's positioned. To Dick's point, we continue to watch it closely, but we couldn't, with conviction, articulate a better strategy to use right now when literally across the board, a movement from fixed income to equity could only increase your exposure to risk at a time where you want no risk in the portfolio. Yeah, go ahead, Gary.
Is consumer confidence data that you have supportive of this, contrary to it, or irrelevant?
Consumer confidence is down. Higher inflation and the war in Ukraine will do that. So I think the contrary data is the fact that people are still very strong balance sheets. Still a lot of cash on the sidelines. Unemployment's near record lows. So while they may be nervous from a confidence standpoint, the facts about their circumstances are still very good. We still have a major employment problem. You know, frankly, less demand would be a good thing because we have 11 million open jobs and 6 million people looking for jobs. So less demand would slow inflation. Again, I think everybody responds positively if we start to see those numbers start coming down. But, you know, people are nervous for sure.
Yes, thank you. It was a well done job here. The question I'm going to ask is, please don't take it in any political sense or judgmental sense. But as I look at these numbers, it appears to me that separating year-to-date 2022 and 2021, if we had still retained our 40%, 60% split in 2021, we would have prospered. We would have earned more because the equity returns were quite good. But we're in 2022, and it looks to me like regardless of our mix, had we not changed, our returns would be very similar to what they are. I would like you to weigh in and correct my understanding of it. It's just a matter of knowing where we are. I'm not trying to second guess any decisions anywhere. I'm just looking for your view on that.
No, I think both statements are absolutely correct. You know, there's truth that there's an amount of luck involved in investing, and we are in a, you know, it's, from our perspective, as Frank said, we never want to start a relationship and lose money from the start. If we had been your manager for 5+ years and we've got some track record and some returns, and we come and talk about this, you know, it's a little bit, okay, well, we've gained 30% over the last 5 years. We understand that markets fluctuate, but yes, in this quarter, I don't think you'd be much different. You'd probably be a little lower because you can, as you saw, the international markets were worse than domestic markets. So that would have probably brought the return down slightly, but it's a weird environment where both fixed income and equities are down about the same at quarter end.
We'll see what happens next quarter.
Well,
I don't think I know the answer to that one. I bet you don't either.
No, I don't. I'm not going to pretend that I do. What I do know, though, and I think this is important, is that the fixed income will earn yield for 9 more months. You know, so there's 2 to 3% of buffer that's going to come back into the coffers just by the nature of owning fixed income. Now, you can say, well, equities will own dividends, but I'm okay with, if I'm at my worst in fixed income and I get that 2 to 3% back, I feel pretty good about that. I'm not sure I'd trade that for equities now, knowing the potential additional downside you could see, you know, the added risk there.
Thank you.
Yeah, I like to use analogies a lot, so I like to use the descriptor of like when you go to Disneyland, there's the teacups and there's the little roller coasters for the little kids, and then there's like the giant Superman rides. If you had stayed in the 60-40 allocation, you would have had some really elated highs, and your portfolio would have, you know, maybe crested at 40 million, and then it would have lost 20% of its value, and you'd have been right back down to where you are. It just would have hurt more. It felt great, but there's science behind the amount of pain someone feels for losing half as much as they win, the positive elation they get from winning. So if you win $100, but you lose $50, like the pain of losing $50, like I just can't find it, it was right here on the counter, hurts worse than, oh, look, I found $100, that's cool. It's the same in your portfolio. You'd have felt great about it, regardless of who your manager was, and then you'd have been calling people in to answer questions about why the portfolio is down 40%. So I think that concludes our formal remarks. This is kind of a science nerdy slide that I thought was interesting. I'll be real quick on this and then we'll wrap up. What this is showing is very complicated, so I'm going to center us on this little crisscross right here. So the portfolio benchmark, how the portfolio is designed that we're trying to follow, has a relatively low risk as measured by an annualized standard deviation, but also has a negative 5% portfolio. So what we want to be in a perfect world is in this like upper left quadrant right up here. We want high returns with not taking on a lot of risk. You know, the mutual fund and investment that everybody wants. I want high returns and no risk. By consequence, you know, the high risk is way out here to the right. You can see commodities, real estate, small market, all doing really well, but taking a lot of risk to get there. We're, as a portfolio, just a little left of the benchmark. So we're taking on even less risk than the market for the comparable return. So we feel good about the fact that from a standard deviation perspective, we're not really taking on any more risk than expected. We're also not taking or experiencing any negative returns beyond what the portfolio is. So it's an interesting little side note to show that we feel good about where the portfolio is allocated versus this huge risk out to the right for huge negative potential returns down the bottom. That's that. Any further questions? Pete, did you have a question you wanted to talk about? No? Okay.
Well, Frank and Nathan, thank you very
Yeah.
much. And as I will remind our audience, anyone who's not been involved in this, they are investing per their instructions from us. So we have mandated the blend of the 90-10 for them, and that is in line with our financial policies, which the number one policy is the preservation of capital, and that is what we're doing. So we thank you, and since we do not meet in the summer, we probably will not see you again until October. So have no idea what you'll have to tell us in October, but I'm sure it'll be very different from now.
What happens in the summer? Where does everybody go?
Well, I mean, we're both here anyway. If you change your mind, you can always do a Zoom call.
We can do a Zoom. We can do virtual. All right. Thank you all very much.
Thank you. Appreciate it. Next on our agenda is a review of our March 2022 financials, and Pete is at the podium to go over those with us.
Thank you, Ann. Good morning, committee members. Appreciate your commitment to this committee. I very much appreciate it, and you guys do a great job of challenging questions all the time, so I appreciate that. Just as a reminder, in our previous BNF meetings, the financial statements were difficult to audience members and committee members at times to see, and also difficult for me to highlight using the laser printer. And so we continue to present this PowerPoint of the material dollar variances against the budget and prior year for both the current month and for year to date. The full financials are always attached to the agenda and are posted each month to our suncitywest.com website. The first slide is revenues for the current month. You can see that against budget. The most notable comment I would make is that every category was favorable to budget, which is obviously is very encouraging. Similar to many other months in this fiscal year, golf course fees and bowling continue to post solid revenues. However, in particular, this month, special events was sizably above budget due to very successful recent events such as the Top Hat Series and the Spring Fest. So overall revenues are up $417,000 versus budget and $455,000 versus prior year. Moving to expenses, unfortunately, the most notable comment is that every category had a negative performance against the budget. Some of these are not very material, such as wages and benefits, which is over budget by about $8K against a budget of almost $1.3 million. And virtually all of that is due to higher health insurance costs that we've discussed at previous BNF committee meetings. For equipment, near the end of virtually every year, IT purchases a sizable number of PCs and laptops for operations. So overall, expenses were over budget by $179,000 and $209,000 higher than prior year. So the operating margin for the current month was a favorable $238,000 against budget and $246,000 against prior year. Moving to year-to-date revenues, many of the categories have the same explanations as the current month. Overall revenues year-to-date are up just about $1.5 million versus budget and about $1.9 million versus prior year. Expenses year-to-date are virtually right at budget with literally a 0% variance. This is occurring despite an approximate $280,000 governing board approved additional spend for grass seed described in previous BNF committee meetings. Overall expenses year-to-date are unfavorable to budget by $74,000 and negative to prior year by $1,364,000. Going forward, the finance department thought we'd take a moment each BNF meeting to highlight one particular area of the income statement for some history and projection. The most sizable expense for the association, of course, is wages and benefits. And you can see on this slide, this expense has performed pretty well in the past 3 to 4 years and has been most impacted by non-wage factors such as health insurance. As we've articulated during the proposed budget proceedings, there exists a need to invest in wage adjustments if we want to remain competitive in recruiting and retaining staff to keep the association's amenities in top shape. Regarding FTEs, you can see the impact that COVID had in FY20, and essentially we've remained at that level ever since. Moving to the year-to-date overall operating margin, we're 1.409 ahead of budget and about 544,000 ahead of prior year. Another slide we'd like to introduce to the committee is our operating margin in a graph format. The red line represents the budgeted operating margin each month, while the blue line represents the actual operating margin. Other than a few months in the fall, there has been a positive performance each month during the year. So I think that bodes very well for how we've been doing year to date. Moving to the capital-related portion of the income statement for the current month, the number of APF transactions continue to be very strong. For unrealized gains and losses on the reserves, we don't budget for any valuation change, and as Frank and Nathan articulated earlier, the weakening bond market and equities decline has negatively impacted. Overall, the capital-related variance for the current month was an unfavorable $458,000 against budget and $250,000 behind prior year. Year to date, the APFs have been very strong all year. In fact, a little research that we did indicates that the month of March was actually the strongest net APF number on record. Some of that has been the Cahovanian build near Fry's that I'm advised that of the 50 lots, about 35 have already been collected upon. 15 are in inquiry mode and only 5 remain without any contract activity. So that obviously has been very helpful. For unrealized gain or loss, again, the declines have been, in recent months, have been pretty notable. So overall, the capital-related variance for the year-to-date is 977 unfavorable against budget and 2.8 million against, 2.8 million against prior year. So bringing both the operating and the capital-related portion together, for the current month, we had a favorable negative 220. Well, against prior year, it is pretty much break even. While year-to-date, a favorable variance of 432,000 exists through 9 months against budget and 2.2 million below prior year. Any questions on any of this part before I move to capital? Sorry about that. Mike, if you'd go to our next slide. Thank you. The governing board approves capital spend of about $5.7 million. To date, purchase orders have been issued of about $5.2 million, with about 4.8 of that against current year capital items and the rest against prior year carryover budget items. About 1.1 million of the current year capital items have been completed, paid for, and upon those items, a favorable variance of about 105,000 has been recorded. Items to which purchase orders have not been issued to date is pretty small. As we near the end of the year, most likely these remaining items will be encumbered. Regarding the unanticipated spend allowances, the budget allocation of 395,000 has had 268,000 of purchase orders issued. So favorable, or excuse me, a remaining variance of about 127,000 remains for the last quarter. Moving to the percent of fully funded balance, strength of the reserve funds is next. Most notably, along the bottom of this slide, demonstrates a pretty solid position for the next 5 years. And this final slide shows the impacts within the current year that impact the fully funded balance percentage, and there are positives and negatives. We began the year at about 58%. Inflows have been doing very well with positive 1.4 million variance in the operating margin to date. Results, higher earnings on the reserve funds due to higher yields. As we mentioned, APFs have been very positive all year long. In the outflow, the projected savings likely to occur within the capital spend are noted, as well as the remaining balance on the allowances. Of course, negatively impacting this has been the valuation change of the portfolio, but we are projecting to have a 55% strength balance at the end of the year without imputing any of the effects of these items. So there's 3 months to go, and we'll hopefully continue on retaining that balance. So any questions?
Pete, I've got one question for you. On your estimated cash flows going forward for the next few years, I noticed you have not changed the amount of irrigation for fiscal year 22-23, although that is projected to be much higher now.
Yes, good point. And if you guys would be willing, I'll have to ask Cliff. I don't know if this has been updated to all the budget elements, so I did not anticipate that, and so this rightfully, in my opinion, still just reflects the current year. You're correct that I have not imputed any of the projected new stuff. I will do so at the next budget. However, I would say that the most recent one updated for the budget has all of that in there.
Okay, because I'd like for us to see that next month for sure.
Okay.
And get that updated. The other question on the budget allowances, what was the reason for more than double actual on the changing demographics?
That's the village store remodel.
That's what I thought, but I just want to know for sure. Thank you.
Ed? No, go ahead.
Okay, my question was on the savings amount that we have and the approval for the remodeling of the village store. The board approved that project, I believe it was around 160, but in actuality, the savings will go towards that, and they'll actually spend less for that project.
Not entirely. The allowance covered all of that. So
the allowance covered 160,000.
Yes, yeah.
Oh.
So the 395 had almost 200, upper 200,000 remaining as we exited out of the year end, meaning the calendar year end. And this issue arose, and then we proposed to the governing board that the allowances continues to have a remaining balance. So nothing of the savings is impacted by that at all.
I think we could say, though, that the allowances will cover it, pending that in the next 2.5 months, we don't have anything that we need those allowances for.
Correct.
Pete, I'm going to put you on the spot on this one. Lizard Acres Pub, where are the dollars on what line item where they showed? Are they under food and beverage, merchandise sales or ancillary revenue?
Food and beverage,
Food and beverage? And how much of that is, of the 53 in the current month comes from there, approximately? I'm not going to put you
Sure.
down. Percentage,
actually,
maybe?
let me
Percentage?
actually tell you where you'll be able to get that more on a higher level clarified for you. The bowling / pavilion committee requested that we provide that for theirs because it's part and parcel to their areas. I just got that data not too long ago, and roughly about 20,000 a month is the, what we call, make sure everybody knows, net amount that flows into the revenue side. Thus, the sales and the cost of goods sold represents the revenue side. But down in the bottom portion of the income statement is the salaries that are due to staff it, and any expenses spent for equipment or other, supply items are registered there. So it's not all in one area of the income statement, but I would say that it's running at about a $2,000 to $4,000 favorable contribution in any given month.
Thank you, Pete.
Pete, I also have a question. Maybe this is just a tutorial for me, but projected percentage of fully funded balance as the end of June 30th of this year. It says 55%. Is there a number, a benchmark or a target that we look to? I see that on the previous spreadsheet, it's really from 47% to a high of 58%. What am I reading? What does that tell me?
Now, that's a very lengthy question, but because it drew upon a tremendous amount of work by John and Lou Mancuso, Terry Burks, in a subcommittee that helped us analyze the lineup here, which was the investment earnings that were likely to be needed, plus the preservation of capital that Ann alluded to earlier. But with all those factors brought in the industry, especially for organizations that are unique to us, like large-scale retirement communities, HOAs of our size, the standard goal for the industry is to be between 30 and 70% fully funded is considered very, very satisfactory and very unlikely to ever require a special assessment. The board analyzed that, especially in the wake of John's presentation a year and a half ago, where we made the switch to the 90-10. That strength of the fully funded was evaluated to never approach anything close to 40% or less. So they actually enacted a governing board approved policy change that measured that as a point when there would be concern about what we would have to do to respond to that. At this juncture, that's why we kind of highlight 5 years out and feel comfortable that that percentage ranges in an acceptable band.
Thank you, I think.
Yes,
Yeah,
Kathy.
just sometime in one of our meetings, I would be interested in seeing the draw on the reserve fund over a 10-year period, just to alert ourselves of any, I call them tsunamis, that may come at us. So that would be helpful.
I actually failed to do that for you. I apologize. I remember you asked for that, but I could articulate to you that I look at it all the time, and I believe it's I believe it's still in the upper 40s at the absolute low end.
Pete, I have one more question for you. It sounds like this fully funded reserve is a very critical metric, and it's one that we should be watching. I guess the concern I'd have with this would be the same concern I'd have kind of with kind of the global financial economic issues, and not necessarily that we can influence, we in Sun City West, but we could perhaps we're measuring how that's going to happen or what's going to happen. And ergo the whole issue with the investment strategies and the whole thing. So I guess kind of the short answer to this is I think this is something that's critical, be a critical metric along with many of our other critical metrics that we have.
Agreed. If you'll stay on that one, here's a 5-second version of how I view it. For the inflows of our fund, 70% of it comes from our APF. If you want, in my opinion, an item that needs to constantly be watched is those sales, and we've been running a very, very strong market lately. You've heard them talk about the likelihood of cooling it down by raising interest rates and mortgages. 30-year mortgages are already at 5%. That's up from 2.5% just a year ago. You know, anyway, you all know what the impact of that would be. So that 1,200 run rate that we have is kind of our benchmark. And the highest risk, in my opinion, to this whole thing is whether or not if 70% of your inflows are rolling through that. You just really got to keep a measure on that. On a much more modest level, the income investments, in a weird kind of way, the bond portfolios have been taking a hit, but right now they're purchasing bonds at a 3% clip right now, and so we have the model built at a 1.5. Now you're not going to get, these bonds are thousands of bonds in these mutual funds, so you're not going to get go to 3% overnight, but slowly you're going to raise your yield, and as that does impact us, then a favorable environment will happen in there. I'd much rather have what they've alluded to, less short-term loss on the bonds and less yield, but that's the situation, and you got to think long-term. One comment I think I make to a lot of people is that if we just bought a bond and put it on the balance sheet and got our monthly dividend off of it, we would never make a valuation change on it real time like we do on the mutual funds. That would just, as it matured towards, its maturity date, it would come back to the par level that you bought it at. And so right now we're taking about a 6% hit on that year to date because of the interest rates have made them less, valuable. But as those mature, it's going to, as he mentioned, they should start to come back, especially if the interest rates do subside after doing their effect, then we're actually in a position to recover that. So you have to think kind of long-term on that too, in my opinion. The biggest impact down here from the CFO's perspective is the FFB. And that inflation level right now is built into our modeling at 3%. And for 5-6 years, a 2%, run rate made you want to say, boy, we're being way too conservative. Throw that out the door in the last 12 months, but you got to be careful not to overreact. As they mentioned, it could come back down. And generally speaking, we don't change the modeling for any short-term position like that. But if it were to sustain itself, then that amount of what we call the absolute replacements would have to come into play. But to be quite blunt, the one last caveat that you would have as a fallback position is your new capital. You as an oncoming board member will be requested for all these decisions as part of the governing board, and you have to evaluate, I think you should evaluate the strength of the reserve funds, because in the manner that we do our reserve funds here, our new capital is baked into it. And so, I hate to say a worst case scenario, but you would probably have a fallback position where, if it was that detrimental and you were approaching 40%, probably the first thing to go would be some new capital spend. That's how I view it. So.
Thank you for a job well done on this. I've got a couple conclusions based on this, and I'd kind of like to test them and see if my understanding is correct. I'm trying to boil this down for, if you will, from maybe a higher 30,000-foot view for the benefit of others in the community. My takeaway of this is that we have had a very challenging year in terms of capital jobs being done. Labor and material inflation and labor shortages have to have presented a challenge. Yet it looks to me, as I see it, that all the jobs are being done and we're coming in on budget as a general statement. So I'd like to know if that is an accurate view of things. And then our second question is, are there any jobs that materially affect the community that we've had to cut or push off into the future year? Two parts. Thank you.
Well, we have a weekly general manager meeting. Literally, one of the topics that are approached every week is the status of our openings. Some of those have been in past. A lot of times those are impacted by people that were out of the office due to sick on COVID leave or things like that. So that's where the genesis of that update, because for quite a while, about the only item that really was being impacted was golf maintenance. For all the reasons we've articulated, it's a tough job. It's our wages, quite bluntly, are not competitive, and thus why we're proposing the change for the upcoming budget year. But we've started to see both, in the nationwide, but also at our local level, we're starting to see rec center, even some of the highly desirable positions, such as facility assistants at the golf courses. With usually those are part-time and are viewed as somewhat plum because we offer up some golf discount, and it's something that people, generally speaking, are attracted to. We're even showing some difficulty in those. And I call that a little bit of what I'm hearing in the nationwide level, the great retirement, is that some 4 million people, by some estimates, have just said, whatever wage you pay me, it's not enticing enough for me to go into that environment. I've got my savings and my pension and my lifestyle fixed, and those people just aren't extracted out. So to answer your question, are we getting it done? Yeah, but on the backs of a lot of highly dedicated people. A lot of our supervisors at the courses, at the facilities, are working a tremendous amount of hours to keep it floating. And I don't think that's fair to them, and I do believe this committee has been unanimously, in my understanding, favorable in advancing our best ability to recruit and retain next year and currently, and that's what we're going to keep proposing to do.
In summary, then, are there any capital jobs from the 21-22 year that we're pushing off into next year, or are we on schedule, if you will, for those?
I know Carl left, but actually, if I'm understanding it right, that you're saying, well, you're correct. Capital is broken up into construction projects, golf projects, and then a lot of equipment. Equipment is completely irrelevant to that. All of our current year construction and golf related ones have advanced. So yep. I'm not aware of anything being held up for that reason.
Yep. That's it. Thank you.
Okay, thank you, Pete. Yeah. Appreciate it very much. Do I have consensus with the committee to accept the financials as presented? We do? Okay. They will be filed as presented. Thank you very much. The next item on our agenda is one we're going to revisit, which is revised policy FI-10. This was presented last month. There were some questions. It was sent to our attorney. It was then discussed at the governing board meeting in March, and I hope all of you on the committee had a chance to review what was said then. I appreciate that Gary and Dick and George were all in attendance at that meeting, so you all can help be my memory for anything that I may be missing. But part of it stems from the fact that we're looking at a couple of different issues. If you look at the what's on the screen right now, or read in your packet, the items after number 1, about the middle of that paragraph, have to do with committee service. Items after number 2, which is the final sentence, has to do with board service. Now, remember that no matter what the committee does, the committee can't vote on these things. The committee can forward something to the board, but the board would make the final decision. The board has also signed conflict of resolution statements when they became board members. So it comes down to how much do we need to do here, and where do we want to go with this? So I'm going to open it up for discussion with this committee to decide what we're going to do and if we're going to send it back to the board. Any comments? Because it is, as it is now, it would just
Madam
stay.
Madam Chairman, I'll start the ball on this one.
Okay.
I
thank you.
think that one of the things that we must always remember as committee members, this is written by our attorney, and it is written by our attorney to represent in front of a judge. And the thoughts and the process that we have going forward of what we may or may not believe is in our personal best interest, we're not the ones that are going to be standing in front of the judge representing the association. I think it's well written. I think it's very concise, and it really comes to personal responsibility that's on there. If you believe at a portion you have any issue, all you have to do is state it, and that's what it really comes down to being. And I think that in our great community, the transparency that we just went through with our finances and with our investments and the things that go on each and every day here of transparency, this is something that is just as transparent. Thank you.
Okay, so just to be clear, you would take what is currently in the struck out version, you would take that paragraph written in red?
Yeah, I would say exactly how the lawyer wrote it on here, because he put in I know he put in the statute number, which he has to, and there were a couple word changes. I think the clarification between what a committee member is and a director does is concise, and I think that is something that we always need to look at, is that who and where our responsibilities sit.
Okay, thank you. Other comments?
Yeah.
Gary?
If I recall at the workshop, we said that the problem we had in understanding this is that if the committee members needed to not participate in the discussion because of a conflict, then why would they be allowed to vote? And so the distinction for us was it was a contradiction. The way the attorney has written this and then pointed out the differences between the committee people and the board people, I think makes it an appropriate item to approve.
Thank you. I'm going to start off a few comments with a question. Does anyone on this committee or staff or in our audience know of any situation in the last 5 years that has come up regarding this issue and touching upon it in any way, shape, or form, negatively or positively? Without hearing of any incidences that have come up, I'm sort of the opinion this might be much ado about nothing. I I think we have something that's been written by legal minds that understand the repercussions and the uses of words in context. And it seems to me that it adequately, more than adequately, protects our community against any actions that would be detrimental to the community. So as written, I'm very comfortable with it protecting our community more than adequately, and I see no reason for amateurs to get in here and start putting fingerprints on this thing when it's been done by a professional as is. I fully support it as is.
Other comments? Richard?
I think the comments that I would have is we asked for clarification from the lawyers. The lawyers have provided the clarification. It's a closed issue. And as far as past behavior is concerned, it's no, this is designed to move forward, not for what's happened in the past. If I can't identify somebody from 5 years ago having violated it, well, that's what I'm worried about, is somebody violating it in the future. So I think where we are with it right now, I would approve it.
Up. We do have an audience member. That would be the board president, Sue Fitzsimons. Thank you, Sue.
That better?
In terms of the content of what's written, I don't have issue with that. However, it appears to me that this is kind of a redundant thing. First of all, when directors receive their oath of office, they are required to sign that they will adequately abide with policy statement L2 and L10, but L2 deals specifically with what you have written all over again into FI10. So it seems like that part was already covered with the conflict of interest that the directors signed. So I don't know why that would be repeated here. And then a concern that that doesn't cover committee members. However, committee members are not allowed to vote. It's a consensus and a recommendation that comes forth. So I guess why would it matter if they did have a conflict of interest, because they're not voting? So, and in some cases, you might have some expertise that a person might have that might be important to the discussion. So if you're trying to eliminate the discussion, you know, that might kind of stifle that kind of thing. So I just see it as something maybe that's not needed to be repeated. That would be my concern with the entire paragraph. And in terms of clarification on the attorney, what happens is when you send something to the attorney, like the paragraph that was you initially started with, then he assumes that you want to have something put in there, and then he makes sure that it's written correctly. But he's not passing judgment on whether or not this is repetitive and not needed. So there's a distinction there. Maybe that's the question that should be asked of him, whether or not we need to repeat what's already been put down in our bylaws and the signature that that the directors give. So that's my 2 cents.
President Fitzsimons, just one quick question. If I'm not mistaken, I was trying to look up L2 on my computer, but I didn't find it quick enough. But L2 would always trump FI10 in precedence of order of precedence if if a question came up. Is that correct?
They're both policies. I've got L2 in front of me right now. You know, if you want, like, 1.1 says, if any contact, decision, or other action taken on behalf of or by the governing board would benefit any director or any person related to a director, that director must declare any personal or family interest for that issue as hereinafter provided. You know, and then it goes on and talks about gifts, that you cannot receive gifts. And then another one where it describes different types of conflicts of interest that don't relate to financial things. So it kind of covers most of these issues. Is that
So,
is that
yeah,
what you asked?
no, I
I mean,
did not just
and in terms
find
of
it.
trumping, you know, if you've got two policies that say the same thing, just seems silly to add that on.
I'll make.
Go
Yeah.
ahead, Kathy.
Let's remember how this came to us. We were in the process of reviewing policies, and the first statement that's in black on this vendor relationship, can we scroll to the top? Is what was there. And I believe one of the committee members was questioning the substantial interest in this. And so I volunteered to try to rewrite it, which is the second paragraph that is crossed out. The attorney then came into play and rewrote that third paragraph, which I still think, in my opinion, is not real clear hearing the discussion now. Because under number 1, why in the world would we have decision-making process under committees if we don't make decisions? So I still think there's cleanup that could occur in here. But hearing the discussion, then perhaps we cross out all the red and just go back to 6.1. But that's how this, I wanted to give the history of that. This wasn't something that I personally was out to try to railroad in any way. So I still think paragraph 3 is not written very, still could have some editorial review if we keep paragraph 3. So the option is either the committee by consensus moves it forward, either the committee does not move it forward, or the committee moves it by consensus, crossing out all the red and going back to the original. And actually, it probably goes back to the original anyway, because we haven't taken action on it.
I was going to say, if we
right,
take no
right.
action, it goes
Right,
back to the
exactly.
original.
Right, so-
and it would more or less
Right,
die on the
exactly.
vine.
Yeah, yep.
So let's just get the flavor for where we want to go with this. Gary, I'll start with you.
I would support eliminating, but just reverting back.
I'll do the same.
I agree.
I'm on board with that as well.
Richard?
I did not hear him clearly. Gary, what did you?
I said I would just eliminate all the red and let 6.1 stand on its own merit as previously written.
No. Okay. Well, consensus is 1, 2, 3, 5 to 1 that we will revert back to 6.1 and it will just stay as it is written for right now. This may be something that the committee will want to review again next year. Thanks to all of you for your input on this. Moving on, the next item is the 2022-23 operational and capital budget discussion.
Good morning, committee. Just a quick update where we're at with the fiscal year budget is what I have here, and then we have a small presentation afterwards on one of the line items impacting our budget next year, just kind of an informative and discussion on credit card fees. So the update on the budget, okay, so again, just to kind of review what the goals of this budget are, I always like to kind of refresh and go over these because it really drives what we're trying to do here, and especially in conversations with this committee and the governing board, just making sure, again, that we're, preserving and protecting the assets of the association, meeting the minimum reserve funding requirement, which had some great discussion this morning. Also, continuing to invest in new capital projects when we're able to do that, and then all while striving to maintain those standards that everyone is really important. I mean, it's why you're here and why we're so successful. So we have to make sure that we're doing that. Since the last time we presented this to this committee, we made some changes. One of the big changes on the presentation was just an overall, obviously the overall cash inflow changed. We made some adjustments. We'll go over some of those adjustments, but also to the right, just kind of calling out some of the major impacts to the budget this year. So that's what this slide is currently doing. Some of those changes that we've put into place since the last presentation to this committee is staff training. We added some staff training. One of the questions that Kathy brought up at the last committee meeting with insurance is, what are we doing to be proactive with some training of our managers? So we decided to budget some additional manager training. Marie went back and so we put some more money in the budget there. Again, we're trying to keep those claims down, which keep our premiums down. Also, we budgeted, there's a payroll software update that we're kind of forced into, but there are some great benefits of it, so we had to go back to the table and adjust there. We also took a look at our credit card fees, which we'll talk about in detail later, and realized that the projected credit card fees were probably a little bit light for this year, and therefore caused a adjustment to the budget, next fiscal year budget. Also, we added a cart path repair at Deer Valley. There's one of the cart paths is it's pushed up and needs to be, it's a concrete path and it needs to be repaired. So we had to add that to the budget. Also, after analyzing the wage adjustments, we realized that we didn't factor in the impact to our vacation accrual when we did that. So we needed to also account for that. We took a look at the dividend income on our investments and adjusted that as well. So that's a positive impact. And then also the Grandview irrigation deturfing project, which was gone over in detail at the last workshop, is a change, which has been discussed. But anyway, that's a change from the last time. And then we've added a rental rate schedule to the budget packet, which has all of the rates, golf rates and such in there, and bowling rates. Yes, Gary?
Cliff, when I first read this, I saw the cart path repair at Deer Valley, and I thought pretty significant. The way you described it sounds like we had a tree root take a couple sections of concrete out and we're going to replace it. Yes or no?
Yes.
And
yes,
that was significant enough to mention here.
Yes, it's a $32,000 repair.
Wow.
Yeah.
Okay.
Yep. Okay, credit card fees. So just wanted to share the adjustment on the credit card fees. We changed our projection to 520 this year, and project that those will increase to 555 next year. And I've got a whole separate presentation on credit card fees coming up here that we'll discuss. Just kind of wanted to show the trend of the credit card fees with those adjustments. The proposed budget will inject $1.4 million into the reserve fund, and previously it was $1 million, almost $1.6 million. So with the proposed adjustments, the operating is decreased to $1.4 million. There was some discussion earlier about the reserve fund, and As Pete said, we impacted the reserve fund with the Grandview project, and you'll see, Ann, that the FFB projected this year is 52% with that adjustment. Still not to be less than 49% over the next 5 years. Okay, so what are our next steps in the budgeting process? We've got, again, we'll continue to review and analyze the budget and make adjustments where needed as we work to May 26th, where the governing board will be presented with the final budget for approval. And then we've, at the next governing board on April 28th, the capital budget items over 100,000 will be presented for a vote. And then we have our community forums, which we're really looking forward to on the 27th and 28th of this month. Any questions before I move into the credit card fees? Yes, Gary.
On the reserve fund form, it shows the Grandview irrigation project, and I know the number's not correct, but then in 2020, 24 and 25, it shows 3,000,002. Is that Pebblebrook? It is?
Yes.
And then my recollection from the golf committee meetings was all of them were stretched out over a period of time. Would the next one be 2 years out or beyond that?
Most likely a little longer than that. You'll see it explicitly next month when I present it.
Thank you, Cliff. And again, I want to thank you for all the ways you made changes in your presentation based on committee comments. I thought the committee had excellent comments, and you've made it much more understandable, kind of like Budget for Dummies, which some days I need.
Yeah,
and
me too.
It's been great. Thank you for
you're welcome.
Taking all those into consideration.
Yeah, and the team in the finance department, Terry and the rest of the team really have helped that as well. So just some great input from this committee and from the finance team and our management team as well.
Now Cliff is going to talk to us about credit card fees information.
Okay, so I posed this question at the workshop, but how many of you knew prior to presenting this that our credit card fees were $500,000 a year? I mean, it's a significant number, and again, that the cost of making that transaction process easier is substantial, But we'll go over some of the benefits of that, and then we'll also just get into some of the details of what they are and what makes up our credit card fees. So what is incorporated into credit card fees? There's basically 3 types of fees, and these get distributed amongst the different parties in the transaction. But there's transactional fees, there's flat fees, and there's incidental fees. When you start looking at credit card fees, you think, it's just a certain percentage. Well, those percentages are broken out over various types of fees in various types of hands that are in the process. So, who's involved with this process? Well, you've got your credit card associations. Your Visa, MasterCard, Discover Card. Then you have your card issuing banks. So the bank that issues the credit card, whether it's Bank of America, Chase, or Wells Fargo, for example. And then you've got your processors and merchant account providers. So those are the providers who basically process the transaction. And then you've got your payment gateways as well. So the fees associated with each part of the transaction are listed here. Found this great kind of visual online. I put the reference down at the bottom of the screen, but where do these parties fit into the transaction? So you've got your consumer, your merchant, where the transaction is created, and you've got your payment gateway, where the credit card processor is processed, and then you've got your credit card associations and credit card issuing banks. Each person or entity in this process basically collects a fee, and some of those fees are flat. some of them, there's wholesale pricing for all of them, and then sometimes, or in most cases, that wholesale pricing is marked up as well. So where do we sit as the rec centers of Sun City West? Well, here's a 5-year trend on those credit card fees. Again, making this transaction easier does come at a cost. As we increase our rates for our membership fees, our golf rates, as those increase, we're going to naturally have more credit card fee expense because it's an overall percentage of the transaction. So you'll see those grow as we grow our revenue. So far this year, we've had 15.3 million in credit card sales, 214,000 credit card transactions, 396,000 in credit card fees, and our average rate is about 2.59%. That falls in line. Usually it's around 3% of industry standard for the cost of the credit card transaction. Okay, so which departments or divisions make up the credit card expense? Clearly, you can see that our membership department makes up 59% of the overall credit card fees, 35% to golf, and so on. So, when we look at those transactions, if you compare the membership number of transactions to golf, this year there have been roughly 15,000 membership credit card transactions. In golf, there's been 178,000 transactions. So golf makes up 83% of our overall transactions, and membership makes up about 7%. If we look at the sales in golf, 6.4 million, in membership, 8.1 million. Okay, so we all know the downside of credit card fees, right? What are the benefits? This is why we pay these fees. The convenience to our members. I was talking with a member who sits on this board recently, and she said, boy, I just love to call the membership department, pay my membership fee over the phone. I don't have to, mail a check or stop in. And so, the convenience to our members to be able to pay this way is, important. It also eliminates the risk for us in collecting bad checks. The risk, part of why we pay that fee is, the bank is taking on that risk, right? So, the risk, that's a huge benefit to the association, that we don't have to carry that risk. Also, we collect our money sooner in terms of operating cash. Having that cash in the bank sooner is good for us. But more importantly, it makes the transaction process more efficient, not just from the standpoint of the member, but for us. I mean, think about all those transactions and having to balance, all those deposits and such. So, it's a lot easier and more efficient for us to collect payment that way. You're talking about, especially in an environment where it's, hard to find people and hire people, we would certainly have to relook at our head count if we had to process all these transactions in a traditional manner. And then, obviously the members benefit from the credit card incentives. We all have, cash back or travel miles or whatever. So that's a huge benefit to our members as well, that they can, use that transaction and benefit from it in that way. Okay, so the point one of our governing board members brought up in the last presentation, wanted to see some of this information, and we said that we would present it here. So we have, but the point of this presentation is to educate our members, but as well to, you know, kind of spur on any discussion that we might want to have take place here. If there's any further questions or just discussion in general about, you know, our credit card fees and their purpose and what we do. So let's do that now. Gary.
Open it up to the committee. Go ahead, Gary.
This is just a suggestion for your presentation, because it may come up at I assume you're going to present this to the governing board?
Yeah, I guess we can.
You identify the transactional flat and incidental fees, and in your slide showing the credit card sales, the transactions, there's $396,000 in credit card fees. So that's about $135,000 left between flat fees and incidental fees, not knowing what those were. If you maybe define those a little bit and what the dollar amounts attached to them would be, I think you'd be complete.
Okay, yeah, I can do that.
Yes, the flat fees are the rates that the credit card companies charge, is that correct?
Not only rates, but there's also a per transaction fee. But yes,
Okay.
not just the percentage rates.
Which leads me to more of a future question here.
Mhm.
Obviously, American Express is not in there. And at least in some Google work I've done, American Express has tried to make their rates more competitive, and they're dropping as low as 2.3 to 3.5. Now, I'm not an expert in this area at all, but I would advocate start at least a revisit to American Express and maybe any other emerging credit card that the generations behind us are using more of.
Yes.
Just
so
a thought.
So the 2.3% is that just factors in the rates that they collect, being American Express, but you still have the additional fees and charges above that. So I think them coming in at 2.3% probably puts them more in line with Visa or MasterCard overall, but it's still going to overall be more than 2.3%, which is what we pay more than 2.3% anyway overall. But yeah, no, we can take a look at that. I mean, American Express is the only major payment carrier that we really don't accept here. But yeah. So you can leave home without it here, right?
Cliff, I have a question. To me, it appears that when you compare dollars and cents, the cost of the transaction fees, one of the things you talked about was handling bad checks and that sort of thing. Do we have an idea what our write-off is or a cost of doing business now? I mean, I can't believe that a lot of people write checks, but that's not necessarily true.
Right. So we don't have any write-off pertaining to bad checks, to answer your question. But we do have, we carry, it's about 70,000 on the books for allowance, which is, I forget what percentage. I can get the details on it, but we don't have any pertaining to bad payments.
Cliff, my question is looking into the future, and Kathy reflected on this with future generations that are going to be coming. I think we need to be looking in the future to how we might accept cryptocurrency and how those fees might add in. And
that's interesting.
How we would do that. I'm not going to be one of these people who's using it because I don't understand it, but I think we will have future generations coming in, and I think within the next 5 years that could be a possibility. So.
No questions.
Good presentation, no questions.
Just comments on this one. I'll be long-winded. Cliff, you said there was approximately $8 million for membership fees and $6 million plus for golf fees. Just about.
Yes.
Okay. One of the things that when you think about this, we do not in any way or shape or form want to put any more burden on the golfers who play here. Okay, and that is just something else. But when you look at the numbers of how balanced they are, the amount of transaction fees needs to be focused in that area because they're the ones that are creating a majority of it. even though that 59% was up there, that represents 94% of all of our fees, those two items. So we need to be taking the opportunity to focus on what we can do to improve both of those. And again, it's easy to say, we're going to charge a fee, we're going to do that. That's the easy thing. But that's not the right thought process that goes with that, because it's the way of how people pay for things now. The other question is that, and again, with that 94%, let's be careful on not, as we always used to say in retail, of jumping over dollars and chasing nickels. Okay, look at what we're really doing with the fees and how we can do it. I think that as a association, we have many, many opportunities with the combining of our IT system that I'll put right up front. Katie and her group has worked immensely on over the last 7 years to bring us up to a standard that we should have. The other thing that when it comes to these credit card fees, how can we get the incentive? You do quick math, just quick math. You said that there was approximately base 550,000 in fees coming up projected, right, Cliff?
That's correct.
Okay, we have approximately 28,000 residents. Quick math, that's about $20 a member. Okay, so where's the focus going to be? You know, you don't want to put the burden on the golfers because they're using a majority of it. How do we look at them and how do we help fix that issue? Thank you.
Good points, George, and I think our finance department will take those into consideration.
Yeah, absolutely. And, you know, one of the things that we've talked about too is if you look at those revenue segments, you know, one of the things you have to consider when you're talking about bowling and golf is we are competing for business there with the public. So we have to offer these services. Now, you could argue membership, we have a captive audience, right? We're not competing per se. So, but again, there's a balance here, right? Are we gonna trip over, you know, dollars to chase nickels? You know, so that all has to be considered. But yeah, thank you for your input there.
I guess I would be remiss in, Anita, are you still with us or have we put you to sleep? Because I have not included you in the conversations, and my apologies to you.
Actually, I am here, Ann, and I do have a question.
Yes.
I know my husband handles all our finances and handles our payments to the rec center for our annual dues. And I know he makes them via credit cards. Is there been any consideration to do like what the state of Arizona, the IRS does, where you can make the payment directly to them via your account where, you know, instead of having to write a check, you just, you know, basically ACH it to the entity. And that would, I think, would reduce some of the fees, would it not?
That's a good suggestion.
I might throw a quick history on that. I talked about that initially when I got here, and don't take this like we can't do this in the future, but the auto withdrawal was always set to be the same amount, if I'm told. And so when there were occasions for dues increase, the bank was doing the withdrawal, splatting it against the outstanding amount, and when it came up short, then late payments were starting to be imputed and your cards were being shut off. So we had a lot of work to do to get it functional. I think we did inquire into whether or not you can prompt the withdrawal to be modified before it's triggered, which is an option we maybe could consider. But I would tell you that attempt was made, and I think there was a lot of discontent, and I think it was put on the back burner.
Yeah, I would not be an advocate of automatic withdrawal, but Anita makes a good point. I know I just recently paid the second installment of our Arizona real estate taxes, and I was able to do that as a bank withdrawal, just coming straight out of my bank at no fees. And I also remember the olden days before when I had to write a check to the rec centers to pay my association dues every year. So we haven't had this amenity for all that many years.
Yeah, there's usually a carrot and stick approach with that. It's usually, if you pay with your credit card, you pay 3% more. But if you pay with ACH, we'll direct. So we would have to probably put an incentive in there for people to use that, whether it's a rebate or something. But it's something that we could certainly look at.
George, I think you've got a comment.
Pete clicked in first. I'll wait. I'll gladly wait.
The only other comment I was going to make is, many of you are new committee members this year, but a policy change was initiated not too long ago, maybe 6 months or so, where as we improve the portal where you can put more money out on member credit, we strongly encourage that. So there used to be, believe it or not, a fee to actually get your unexpired or your remaining balance of your member credit back to you, which we extinguished that. And we also, I have to double check, but it's my understanding we did increase the minimum amount on the credit, member credit amount so as to reduce the number of transactions. Small impact, but as people become more comfortable on it, I would like to believe that it's money they can use endlessly for whatever they want to do. So if you're paying for every time you go out and golf with a credit card and you're an owner member, if we make this, out into the open, they could punch a considerable amounts of money onto member credit and just have no transaction fees for the association. So.
But you would have a transaction fee, as my husband does every time he puts $200 on his credit card to pad his golf account.
For you, the fee?
Yeah, he does that. He
Oh,
puts
I'm not
he puts
sure why
money
that
on
would
his
be
card,
that.
but he uses a credit card to do it. So somebody's paying it.
Yes,
George?
you could reduce the transactions, but there still is a fee. Yes.
Yeah. George, what do you?
Just the odd thought on this one. Even though we're talking about credit card transactions, where it is, or how much are we going to be putting back into our coffers by the lack of manual labor and savings that goes along with that? And when we talk about that, I know it's because we don't have the staff now that is showing that, but still there is an offset that's on that side that we need to also consider. Thank you.
Well, we do, because it's not all total $555,000 expense. There would be a trade-off.
Absolutely.
And it's hard to know what that would be.
Yes, there definitely, yes.
So, thanks to all. Gary.
Credit card companies are vicious. You reduce your transactions, your percentage is going to go up. I don't know where we are on the continuum, but they're going to get
Right.
theirs one way or another.
You're probably right. I think one thing I wanted to mention that he brought up, Cliff, was that our amount is in our fund, and maybe many of you don't realize this, but our Chase bank account, our operating account, gets a credit towards our fees by the amount of the balance at night. So it's earning essentially an amount. So it's probably relatively small, but every bit counts as far as if you have the money, then you can get more money against that offset.
Richard, did you have something?
All I'm going to say is that in my past life, I did work with the credit card companies, okay, setting these systems up. And maybe I should admit that. Yeah.
That explains a lot, Richard.
Yeah, but basically, one of the things that we used to consider is that when I had the manual process, it was about a 3.5% to 4% error that we usually found with an establishment, where they couldn't recover the transactions because they were completely lost. The other element of it is cash management. Depends upon how large you are, of course, but you could scoop up the money. And the other thing is, believe it or not, it gets down to safety issues. People that used to deal in cash and things like that, someone comes in to rob you and they say, I want to rob you. Well, good luck. There's no cash in the company. So those are things I think also, these are the soft things that you have to take a look at.
All good points. Thank you so much. Thank you, Cliff.
Okay.
I want to do a reminder that we will have our community budget forums next Wednesday, the 27th at 9 a.m., and next Thursday, the 28th of April at 5:30 p.m. Those will both be here in the lecture hall. And encourage anyone who is listening to this, any audience members, to please try to attend. This is your opportunity to see the budget, your opportunity to ask questions. and it's always a good presentation. Before we have committee comments, I do want to tell my committee that I will not be running for treasurer for next year. I have thrown my hat in the ring right now to be vice president of this organization, but the election will be next week, so that stands to remain to be seen. Who else might put their hat in the ring? Right now, the one person running for treasurer is our own Dick Rhodes. Those of you on the committee, if you would like to stay on this committee, if you want to jump ship and go to another committee, I don't know why you would, but I mean, if you want to, you could. But committee applications are available online, and I would suggest that you go ahead and fill those out. They ideally should be filled out every year to be on a committee, and I send this out to our listening audience too. It's very important to be involved in the different committees. And as soon as the elections are over in early May and the committee assignments are made by the new president of the board, those chairmen will be looking for their committee members. And there's always a scramble among some of them because they want to get the best people. So I encourage all of you to do that. So we will move on to committee comments. I'll start down at this end. George?
Thank you. I just want to thank the committee for allowing me to serve with you. You guys are incredibly intelligent and incredibly ask the hardest questions, but with the kindness that comes with it. And you give real answers to the association and to the owner members. Thank you, and pleasure serving with you as chairman. Pete, your staff, I have to compliment them. They are incredible in the amount of information they give out. And I also want to throw kudos to two other people who have attended every one of our meetings, which is our current president and vice president. And I want to thank you for your interest in knowing what goes on in our community. Appreciate you very much. Thank you.
Richard?
Just echoing George's comments. Very well done.
Well done, George. Thank you. I agree with everything you said.
Yeah, I've only been on the committee for a few months, but I really appreciate the leadership that you have provided for us. And I can't say enough about the staff, the finance staff. I think they're really remarkable. So you all have a gift. Thank you.
Yes, I want to thank you, Ann. I think you've done an incredible job in kind of a neutral position in trying to get the comments and maybe differences brought together. So I want to thank you for that. We will miss you if we're still on the committee. And yes, Pete and your staff do a good job, as I would expect.
Echo all of that, and I only have one question. How many slots are you going to have on the vice president committee? I'm sure you'll need one.
I may. There's a lot of vice. There's a lot of vice in Sun City West. Oh, and Anita. Sorry, I almost forgot you again. Do you have any comments?
Thank you, Ann. I would just like to wish you the best of luck on your future endeavors. And also thank the governing board and the finance department for the great work that they've done. And also kudos to the technology group for letting me be here 1,800 miles away and enjoying and making the comments at this meeting. Again, thank you, everyone.
Thank you, Anita, and I'm glad that it worked out today. We conquered a major goal this year, being able to get you in here. I will have to say, after having been chair of this committee for 2 years, these people on this committee are awesome. I couldn't have done it without any of you, and all you've done is make me look good, as have Pete and Cliff and Terry, the whole team there. They are incredible. Do we have any live guest comments? I guess a better question, do we have any live guests? Yes, sir.
Hello? Okay. 10 years ago, credit cards were not accepted for paying dues. The membership department head came to me and said, we got a problem. We got a lot of people who don't have enough money in the bank to pay $500 all at once. So what can we do? So I called a meeting with the CFO, membership department, and others associated with that. And we came up with a membership department manager said, when the people don't pay their dues, we have to go to the legal department, have a lien placed on their property because of non-payment of dues, and the people can't use the facilities. And these are people getting along day by day without enough money to have enough in the bank to pay it all at once. So I asked the CFO what could be done. So he looked into it and found that if we allowed the membership to be able to use credit cards, that the added volume in credit cards from that purpose would lower the rates on the other credit cards we had already been accepting. So that's why in about 2012, we started to use credit cards, because some people just were not able to make that lump sum payment. Thank you.
Thank you. Could you give us your name and rec card number for the record, please?
Sure. I'm Ed Van Cott. At the time, I was the treasurer. I served for 2 years as treasurer. 122253.
Thank you so much, Ed. I appreciate it. And thanks for your prior service, too. Before I adjourn the meeting, our next meeting date is set for May 3rd. At this time, I do not know of any business that we will have, so I am canceling that meeting. And I can see the committee internally applauding that decision. And our next meeting will be on Tuesday, May 17th, here in the lecture hall at 9 a.m. And the meeting is adjourned at 10:57. Thank you, Dick, for being our secretary today.